Hi, I'm Jared Brown, Australian expat financial planner. Thanks for tuning into my video today. What I'd like to share with you is how to select the right ETF or exchange traded fund for you when it comes to your investment strategy. So we're going to cover off some of the key variables, the things to look at when it comes to reviewing ETF options, whether they're right for you, what some of the risks are that you need to be aware of, and hopefully that gives you a good starting point to have a look at how to choose the right ETF. So let's dive right into some of the key considerations when it comes to reviewing, comparing, and selecting ETFs for our portfolio. Now, within the ETF landscape, there are your broad-based index funds. So for example, investing in the S&P 500 or the All Ordinaries or the ASX 200, the top 200 companies in Australia. Or there's even your Vanguard Total World Index that gives you exposure to just about every listed company that there is around the world, with obviously limitations of any residency restrictions and the like. And then there are your far more niche or targeted or thematic, as they're often called, ETFs such as investing in cybersecurity or cryptocurrency or solar energy or whatever it may be. There are lots and lots of options. There is a new ETF being created and set up just about every week somewhere in the world. So how on earth do we select the right one? What do we need to be aware of? That's exactly what we're going to cover in this video. So let's get started. Now, the first thing you need to have a look at is the actual size of the ETF itself. How much money is invested in the ETF and who is the market maker that manufactures or produces or puts out that particular product. So for example, that might be a Vanguard, a State Street, BlackRock, a large, typically large financial institution that has created this product and often makes the market. So they're sitting there as the buyer, as the seller, creating that liquidity so that investors can buy and sell on a regular basis. Now, the issue that you've got to consider is if that ETF is too small, or if the market maker, the manufacturer, is too small, in the event that there's a liquidity crisis, meaning too many investors want their money out at once, such as we've seen in some cryptocurrency disasters recently, then what is going to happen with that market maker? Will you still be able to get out? Should you limit your exposure, or should you simply avoid it altogether? So do make sure that you're comfortable with the size of both the ETF and the market maker itself. You can do some easy comparisons online. If you're looking at, for example, a cybersecurity ETF, there are a few options globally, and you can quickly see the size of each, compare each of them, and have a look at what's right for you. So that's the first couple of tips to have a look at. The next one to be mindful of is the daily or weekly traded volume of that particular ETF. Now, as an ETF stands for, it's exchange traded, meaning that it's public, meaning that you can log into the exchange and buy or sell that particular ETF on any given day in most circumstances. Now, what you need to be mindful of here is in the event that you need to sell or in the event that you need to buy, how long would it take you to build up your position or to liquidate your position? For example, if there's only $50,000 or $100,000 of a particular ETF trading each day or each week, which would be even rarer and certainly a lot smaller, then you need to be very mindful of how long it might take to actually liquidate a position in the event that it's bad news or you simply need your money back. So make sure that you're comfortable with the amount of volume that is being traded. Make sure that you're comfortable with the position that you're taking in terms of size, and make sure that you'll be able to get in or out relatively quickly based on your own financial goals. So that's the next tip, next variable to have a look at quite closely. The next one to look at is currency hedging. Is the ETF providing any currency hedging? Are they not? How are they doing it? Are they trading on the ASX with a US-based ETF, for example? How are they actually managing that currency risk, or are they not? Now, it's not to say that one is bad and one is good, but you do need to be very mindful of what currency you're actually investing in, what currencies you're exposed to, particularly if you're currently living and working in Singapore and planning to retire in Australia, for example. Chances are, in most cases, when you're looking at your retirement investments, you may want more of your exposure, in most cases you probably should, in Australian dollars. Now, that doesn't mean that all of your investments, all of your shares need to be Australian companies, but chances are you may want to reduce or remove that currency risk by holding more exposure to Aussie dollars. So certainly review that one. Make sure that you're not paying too much in terms of fees for that currency hedge, and make sure that you're comfortable, or at least your advisor is comfortable, with the way that that particular ETF is achieving that currency hedging. Now, the next variable to have a look at is the number of holdings within that particular ETF. Are you comfortable with the number of holdings? These will often range anywhere from 20 or 25 holdings all the way through to thousands. So when you look at things like the Vanguard World Market or Total Market Index, that is going to typically give you exposure to thousands of individual companies. If we look at something like a BetaShares Global Cybersecurity ETF, that might give you exposure to 25 to 35 different companies. Again, it's not to say that one is bad and one is good. To be diversified, typically we need exposure to about 25, 26 companies based on the textbooks, based on the investment theory, but just make sure that you're comfortable with the amount of diversification that you're actually taking on. Make sure you're comfortable with the holdings within that particular ETF, and make sure that you're comfortable with the liquidity and the level of risk actually being taken there. The next one to look at is, does the ETF automatically rebalance? And if so, on what basis do they do that? Is it as simple as once a year, once a month, once a quarter? Stocks that now meet the requirements to be part of that particular index or that ETF are added? Those that are not are removed? Is it something that's a bit more active? Is it that the actual risk profile, meaning the asset allocation, is rebalanced on an annual basis? Make sure that you're comfortable, you're aware of what that rebalancing looks like, because otherwise it may be something that you need to keep an eye on when it comes to actually making sure your asset allocation and your risk is actually aligned to your own financial goals. Now, the next couple of variables to have a look at, of course, are fees. Make sure that you're comfortable with the level of fees that you're paying. It doesn't mean to say that low fees or high fees are good, bad, or indifferent. Just make sure that you're comfortable. Typically, you will see lower fees for a total market, a global market index, and higher fees for something that is a bit more thematic, and that is largely driven by the size of that particular ETF. So just make sure that you're comfortable, make sure that you're comfortable with the net returns that ETF is delivering, and again, do a bit of a comparison. Make sure that you're invested in the right option when it comes to the fees, because you may find that there's a cheaper option listed in Hong Kong, Canada, US, Australia, for example. Again, just make sure that you're comfortable with the level of fees that you're actually paying. Now, the next critical variable, and I touched on this very briefly earlier because it does have a big impact on your currency risk and can also impact your exposure to estate taxes. And that is having a look at what exchange the ETF is actually listed on. For example, if you're an Australian expat, you may want to utilise the Australian Stock Exchange to create and to manage and to generate both your domestic Australian exposure and your international exposure. Again, consult your tax agents. In most cases, that's not going to impact your tax residency, but do seek advice there. Because again, if we're listed on the ASX, the Australian Stock Exchange, that naturally gives us more Aussie dollar exposure compared to if we're investing on the Singapore Stock Exchange, the SGX, for example. We also need to be mindful, I mentioned this earlier, estate tax exposure. If we invest, for example, in the United States, once we actually exceed a certain threshold, which currently is US $60,000, then that portion of our asset base, if we're not US citizens and US tax residents, is now exposed to estate taxes. Now, naturally, that means that if we pass away, there may be some tax payable on that portion of our asset base. So be very mindful there. Make sure you're aware of the risks. Again, if you have any other variables, any questions when it comes to selecting the right ETF for you, some of the risks, your own experience, drop me a note in the comments. Feel free to reach out to me directly. Really appreciate you tuning into the video. Don't forget to like, subscribe, and I look forward to seeing you next time.